In the previous episode, we learned that bonds are issued by governments and corporations to raise money. And in return for purchasing these bonds, you can get interest in the form of a coupon. But there's a lot more to bonds, such as buying bonds in foreign currencies. Sometimes governments or corporations may issue a bond in a foreign currency to support local or regional projects, or to even expand into new markets, or for a variety of different reasons. This gives investors the opportunity to invest in a government or company bond in currencies outside of their home country. And this gives the chance to look at foreign currency bonds where governments or companies may be paying a higher interest rate. The interest rate of any country can move up or it can move down for a variety of reasons, such as growth and inflation. And since economies can differ from country to country, overseas bond options can help you stay on track when it comes to your investment goals. In other words, investors get more opportunities. Let's focus on one country that has many ties to Singapore, and that's Australia. Specifically, the Australian dollar bond market. This is a large bond market with many companies that investors may be familiar with here in Singapore. The Australian Central Bank has made a case to keep their interest rates higher for longer than other central banks around the world. This can be great for investors because the interest rate on Australian dollar bonds may be higher than even here in Singapore, but it could also mean that the Australian dollar could go up more as investors look for higher interest rates and drive up the demand for the Australian dollar. Sometimes in the bond market, we call this a carry trade, or in other words, that's when investors believe a currency can go up because the central bank from one country either raises or holds interest rates while the other country prepares to cut them. So there is a chance to get a higher return on the bonds themselves and also on the foreign exchange. An example of this is as follows. Let's say company A issues a 10-year bond in Singapore dollars at a 4% yield. They also issue an Australian dollar bond at a 6% yield. Now, because the government bond yield is higher in Australia, Company A will need to pay more interest than it would for the Singapore dollar bond. The investor may decide to convert to Australian dollars and then purchase Company A's bond in the Australian dollar bond market to get that extra 2% yield. Now, during the holding period of this bond, the Central Bank of Australia decides to raise interest rates one more time, while the MAS, on the other hand, decides to adjust their exchange rate downwards. As a result, the Australian dollar appreciates versus the Singapore dollar, and for the sake of this example, let's say by 2%. And this would be an additional gain for the Australian dollar beyond the extra 2% they're already getting for the coupon they would normally receive. So let's recap. First, the investor searches for more yield to achieve their income goals. And then they see an opportunity for the Australian dollar to go up versus the Singapore dollar and deliver a little bit more return. Now, of course, investing in foreign currencies does come with a little bit more risk. As the currencies can depreciate as much as they do appreciate, it is important to work closely with a financial advisor on this type of investment. To sum things up, investing in a foreign currency bond, such as a Singaporean investor buying an Australian dollar bond, could help to enhance income and returns through a carry trade. As carry trades add the element of foreign currency, higher returns can also come with higher risk. To learn more about investing in foreign currency bonds and if this is suitable for you, speak to your UOB banker today.